This is the June 18th, 2018 Advance Report for McGowanGroup clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, President, McGowanGroup, pleased to be with you, bringing you the benefit graphically of over 32 years in portfolio management experience. We're going to start this week with a discussion about bonds, stocks, the Federal Reserve, and trade wars, which you're hearing so much about. Well, I'm going to dispel some of the financial media meme right now. First, what we're going to do is look at the small stock index here in the U.S., and then we're going to look at the NASDAQ Composite Index. Well, the Russell 2000 ascended to a 9% gain, all-time highs, and it did it multiple times over the past 2 weeks. Now, we've heard that the Federal Reserve raising interest rates is a bad thing for stocks. Well, eventually it could be. 1.75% base rate. What did the long rates do? Remember, there's an assumption that is a tradable assumption in most cases that when short rates rise, long rates will rise right along with it. That's not true. In 2007, everything was flat at 5.25 from short to long. Well, the small stocks powering ahead. I'm going to show you why on the next graph. The NASDAQ Composite Index, led by tech and media after the AT&T Time Warner merger was okayed in federal court. Everybody's lined up to buy media. If you own the pipes, the cable, or the delivery mechanism, you also want content. Now you've got a race to buy those companies, tech benefiting. Netflix made all-time highs every day this week. That tells you where this thing is going. Now, if we look at the overall stock market, Dow Jones Industrial Average fell back below 25,000 this week. As you know, if you've been tuning in, the high was about 26,500, the low 23,000 in the winter storm, and we've been mid-range since then. They attributed about a 1% decline in U.S. equity on Friday to trade wars. Well, if trade wars are so bad, we've been talking about tariffs, fair trade for quite some time, and yes, it does seem to correspond to the Dow being down over 100, 200, or even 300 points. But the overall markets, one, the Dow stabilized at the upper end of its range, and this says there's something more positive here, even if there are these dreaded trade wars where tariffs get made more fair and equal. So I wouldn't worry about it, and here's the graph that tells you why. S&P 500 earnings. We can go back, and this chart goes 2017, 18, 19. When we look at prior to that, back in 2016, the after-tax earnings of one Standard & Poor's 500 basket, which we can see runs just under $2,800 or $2,770 on the index, well, it made $105 net after tax in 2016. Those earnings had actually declined in the couple of years prior. But notice this earnings explosion we see. Oh my gosh, 2019, it looks like that number could be $160, $165 in net after-tax earnings next year. That's a 60% increase. Yes, about half of it was the lower tax rate from 35% to 21%. It was going to be 20, but Congress has to complicate everything. And here we can see that ascending to a rosy optimistic 195. Analysts tend to be a little bit over optimistic, but we're close enough to 2018 that 2019 that this actually applies. That's the underlying reason. And trade wars, it's a headline you'll hear a lot. Most of it I would just totally disregard because that'll work in the United States' favor long term, in my opinion. Now we're going to get to oil. Oil spent most of the week between $67 a barrel and $66 a barrel, having been to $72 per barrel. Let's take a look. Here, this graph we cover, and the reason we're covering it is because this could be the sector that has had the bear cycle, whose fundamentals are improving, and you can get big dividends. Everybody likes to get big checks. We do too. That's one of our focuses at McGowan Group. Be sure to come down, update your financial plan, meet the team that cares at the Crescent. When you go to networthradio.com, you'll get more details, including the preliminary client questionnaire and more charts and graphs, plus the program that goes more in depth on real investment strategy. Okay, the colorful one is the pipelines, and the burnt orange one, appropriately enough, is oil. And you can see the horrible bear cycle that the energy sector got hit with. It was a supply-driven correction starting 2014. Continues to February 2016. Oil hits 27. Thanks to Stephen Norris, Super Chuck Norris, our allocation director, we have this chart which equalizes the percentage moves in both of these. Would you like an inflation-friendly protection in the future potentially? Well, this could be it. Look, you see how the pipelines lagged in the decline, but eventually caught up in percentage terms. Then we both have a nice rally, correlation there. Then we get this bizarre little sell-off here. That's called capitulation, in my opinion, at tax loss selling at climax. Then we see, that's right here, that's November, right around Thanksgiving. But what we see here is the end of the third quarter. You had a lot of money managers that just gave up on the sector because they've been pounded for 4 years. Ouch! And lots of the brokerage firms were saying this is the end-all, be-all back in 2014 when oil was 100, not so much when it's 27. Now oil's already ascended in this nice smooth graph, hitting 72, now about 66, 67. Pipelines started to rally again, but if we look at the relative value of that sector, it could fulfill part of our portfolio in a magnificent way. If pipelines catch up with oil, I said if they catch up with this graph, which you can see they tend to do, well, the valuations tell us, adjusted for current oil prices, there could be a double over 5 to 10 years in the sector on top of a very generous dividend. Well, not without price risk, as you can see. Here we go. The green sector, growth with income, that's what I've been talking about. Dividend companies that can grow in value by more than inflation. We want to be good at that. High cash flow, we want to be the bank. Global lending, who's going to pay us the most interest? We call it global high yield. And there's some sectors there we'll talk about this weekend that are off the charts amazing in terms of discounts, estimated discounts to par value, and then safety and income. A couple of good choices here. Most people don't know the Vanguard money market, 1.9%, a little over that actually. Well, remember, savings are getting 0, so savers are getting rewarded. You can park it there without a management fee and just enjoy it. And if it's parked here at McGowan Group, we'll call you when we've got a better bargain. Floating rate loan funds have been stable, paying about 4%. They don't have a guarantee, but they have been amazingly stable. Senior loans, 2 to 4 years, and those rates are rising because the short-term rates have come up. What a great couple of parking spaces for the safety and income. Be good at all three categories. Come down to the Crescent, get a plan from the team that cares, and get your tour of our Texas Financial History private collection, including 170-year-old Republic of Texas bonds. I'm Spencer McGowan, your financial weatherman. Thank you for tuning in today. I will be back next week, and if you subscribe and we have a special alert, a crisis in the markets, boom, you're going to get notified, and you'll have a few minutes on YouTube where you can get the real story in the storms of the global financial markets and the successes. We'll be back next week. My firm, McGowanGroup Asset Management, sponsors NetWorthRadio.com and, of course, our YouTube channel under McGowan Group. Some educational disclosures and discussions that I wanted to add to the broadcast. The first is, I'm very proud of our team, including Stephen Norris, who will be added as soon as we redo the picture. He's our newest team member. Come down, meet the team that cares, get a written plan, because the securities we discuss, the financial news we discuss, that's not a recommendation until you actually come down and get a customized plan at the Crescent. You'll get a tour, and we look forward to seeing you. We're going to cover value at risk of loss in portfolios, and you can see it right here. Learn about our performance, what happened in 2008, how long did it take to recover. All of those items are posted right here at networthradio.com or the McGowanGroup.com. The other part of the program, when we look at price fluctuations and bear markets and risk control, that's a huge part of NetWorthRadio.com. We look forward to helping you advance your plan and your cash flow. Come down and meet the team that cares.